Hello everybody, it's Joe from PrepAgent. Sorry I'm a minute late, but here I am and ready to go. If you guys give me a thumbs up, we'll begin. Hope you're having a good day. So I see we got some people from Virginia today. I got some great news for everybody. I've been exercising. It's been a few days in a row. It's amazing that what I used to do as warm-ups when I played high school sports is now a full workout for me. I don't know if any of you guys find that. Like all those little what do they call it? Dynamic warm-ups. I do those dynamic warm-ups and I feel like I'm good. Okay, so it seems like everybody could hear me really well. If you can't hear me, then that's on you. Well, I guess if you can't hear me, then you can't hear me say you can't hear me. So that'd be kind of ironic. Okay, so today we're doing finance. Yuck, what a terrible thing. Whenever we do finance, we need to start with certain basic concepts. First, does everybody know the difference between a conventional loan and an unconventional loan? Do you guys know the difference between a conventional loan and an unconventional loan? Adrian and I were talking about this today, actually. Who here knows the difference between a conventional loan and an unconventional loan? So Inez Panic says government-backed. Okay, so a conventional loan is one that is not backed by the government. An unconventional is backed by the government. Okay, what are some methods it can be backed by the government? Well, you guys hear this thing called a FHA loan and a VA loan. Have you guys ever heard of a FHA loan? What is a FHA loan? What do you guys think? What is an FHA loan? So a FHA loan is a loan that is insured by the Federal Housing Administration. Okay? So when you get an FHA loan, you're not actually getting a loan from the FHA. Does everybody understand that? Hopefully you guys all understand that. So you'll hear the term FHA loan, but it doesn't actually mean you're getting a loan from the FHA. It just means a loan that is insured by the FHA. Does everybody got that? By the way, it's really important you guys follow me on PrepAgent because I post these concepts on our Instagram. Okay? When I say follow me, I meant Instagram. So it's prep_agent. Follow me there. And you can see these concepts I talk about. Usually I post something about on a concept that's related to the webinar. So it's really important you follow me there because all this information I'm talking about is on our Instagram page. Okay, so really try and follow me there and try and engage with other people who are studying. We really try to build a community as much as I can, whether it's on Facebook or Instagram. So I got some videos there, some concepts. I said, follow us wherever you can, whether it's the emails, the Instagram, the Facebook. After you pass, you can move on. You can stay with us or not. But I really recommend, as you're studying, to follow us everywhere we put out information because it's all designed to keep you guys on task. Okay, everybody got it? It's part of our plan. So if you guys are with us, be with us and follow us, and we'll take you there. Okay, so FHA is loans that are insured by the FHA. Do you need a down payment if you're getting an FHA loan? And once again, FHA loan is not a loan being given by the Federal Housing Administration. Okay, do you need a down payment? You do need a down payment, but it's a smaller one. Okay, it's a smaller one. Everybody got that? You don't need a big down payment. The other type of loans that come up when we talk about unconventional loans that are backed is something called a VA loan. What is a VA loan? Who knows what a VA loan is? What's a VA loan? What do you guys think? What is a VA loan? So VA loan is one that's backed by the Department of Veterans Affairs. okay? Now, for a VA loan, do you need a down payment? Do you need a down payment? And this is all on your exam guide. So it's not only just going to be when you practice real estate, it will be on your exam. And this is what today's post on Instagram was about, this VA loan. So a VA loan does not need a down payment. There's another requirement that comes up on your real estate exam and you need to know about VA loans. Now, obviously, there's a lot of details regarding any type of loan, but there's two primary concepts that come up on your exam quite a bit, no matter where you are. Okay, so no down payment. Who knows what the other thing is? There's another really important requirement to get a VA loan. Inez nailed it. It has to be your primary residence. It has to be your primary residence. Everybody got it? Obviously, you have to be a veteran. So it's for veteran or people who are currently serving and their spouses. That's what it's for. Okay, so the other requirement is you have to show you're living there. You cannot get a commercial property with a VA loan. It has to be your primary residence. Everybody got that? Really important you guys understand. So no down payment. It has to be your primary residence. The other thing that comes up that you guys need to know, it confuses a lot of people, is something called the primary market and secondary market. Who knows what the difference is between the primary market and the secondary market? First, what's the primary market? I hope you guys don't mind me going over these concepts. We'll do some questions in today's webinar. It's just that sometimes I think these concepts are important to have a good foundation as you guys study later. Okay, so what's the primary market versus the secondary market? Okay, so primary market, to put it in very simple terms, that's when you go to the bank and you just get a loan. Has everybody got that? It's your conventional place. Oop, I shouldn't use the word conventional. Don't want to get that mixed up. But when they say primary market, it's a fancy way when you go to Chase Bank or Wells Fargo or any of these credit unions and you just get a loan. Okay, that's where loans are originated, just as Jennifer said. Nice job, Jennifer Bevan. So that's when you just go to the bank. Primary markets, where loans are originated. So when you guys go to the bank and a loan, that's the primary market. And some of you guys are thinking, why do you have to give it such fancy terms? Why can't they just say that? I don't know. Okay, so you have the primary market, and then comes the secondary market. Now, what's the secondary market? What's that all about? Who knows what the secondary market is? The secondary market. So I want everybody to write this down. I want to see this all over the chat. Secondary market, resale marketplace. Secondary market, resale marketplace. Everybody write that down. Secondary market, resale marketplace. Okay? Secondary market, resale marketplace. Okay? Now, that frees up money so they can put everything into the primary markets, they can make more loans. Let me put this all in context for you in a little history lesson, and I think that'll help everybody out, all the concepts we just went over. And I'll do it real quick, 2-minute history lesson. Okay, what was happening in the 1920s? Who knows what was happening in the 1920s in America? 1920s. I'll give you a hint. Who knows? Booming. Brandon Brown nailed it. It's the booming. It was not the Depression. It was just called the Roaring 20s. Okay? You guys are off about 10 years, a lot of you. Okay? Babe Ruth was hitting home runs. Everybody was doing swing dancing with those two-tone shoes and those long jackets, right? And, the Great Gatsby was rocking. That was the 20s, right? And what goes up must come down. In came the 30s. The 30s was the Depression, 1934 to be exact. Okay, that was the crash. Okay, as you guys will learn, they talk about the market and they blame it on, who's president or who's in the government and all this. But if you study over history, it always goes up and down, up and down, up and down, right? It really takes a lot of factors to make the market go up and down. So in the 1920s, it was up, and in the 1930s, it went down. One of the big factors in the 1930s is it was a country full of tenants. Everybody rented, and that wasn't good, and that helped lead to the Depression. And the reason was that only rich people could get loans, all right? Only rich people could get loans back then, because you have to put these massive down payments, and you have to pay back in about 7 years, okay? So you had to put these huge down payments down and pay back in 7 years, and that's just not realistic for somebody who doesn't have a lot of money. So therefore, rich people bought more properties very often with just straight up cash, and the poor people could never own, and they just kept renting. And as you know, a lifelong renter is very often leads to poverty. Okay, where if you own property, as you guys know, you build equity and things of that nature. Okay, you don't become rich by hourly work. You become rich from investments, passive income, things of that nature. So the government stepped in and said, banks, you got to loan money. This is ridiculous. Nobody can get a loan. Banks are like, no way. They're poor. They won't pay us back. So then what happened is the bank said, if you make loans, we will back you up. You got to do this. We will back you up. Just make these loans. And the FHA was born. Okay, it was a way to kind of get everybody out of a tough financial situation, which the country was in. So then they lent out a lot of money, but what was the problem? They lent out money because the government said, if you lend out this money, you can't collect down payments, and you got to get the money back in about 30 years. So the banks did that, but the problem is, obviously, they ran out of money because they weren't getting paid back for 30 years. Okay, so in comes the secondary market. They purchased those loans so that the bank could make money by making more loans, and then they would make the money off the long term. Okay, that's when you get like Wall Street and the investments and all that kind of stuff. Then up came later Fannie Mae and Ginnie Mae, which is all part of the secondary market that bought certain types of loans. Has everybody got that? So hopefully that put everything into context for you guys, and it'll help you pass your exam, and maybe it'll be a good conversation, I don't know, at a bar or something when you guys got nothing else to talk about. Okay, so that was when the FHA came in, the primary market and secondary market. Okay, so you get these different types of loans, and then you have the secondary market and you have the primary market we just discussed. Okay, do not get that confused with the first and second loan. Do not get the primary market and the secondary market confused with a primary mortgage and a secondary mortgage. Does everybody get that? Promise me you won't, because a lot of people get that confused. Two different things. Now, a primary mortgage usually has a lower interest rate than the secondary mortgage. Who knows why? Anybody know why? Why does a primary mortgage usually have a lower interest rate than a secondary mortgage? A first or a second? You're welcome, Jennifer. Because the primary mortgage has priority. Therefore, it's a lower risk, and risk is directly related to interest. Everybody got that? Risk is related to interest. The primary mortgage gets paid back first. It's not like you could pay part of it and then pay the other part to the second, like when you borrow money from your two brothers and you have to pay them back like equally. No, you would pay one brother completely and then you'd start paying the other brother. Okay, that's how loans work. It's not like, oh, I borrowed $10 from both of you, I'll give you $3, you $3, I'll get you guys back later. It doesn't work like that. So therefore, the second has to wait till the primary is completely paid back. So therefore, they're in a higher position of risk, okay? And therefore, they have a higher interest rate. Everybody got it? I'm going to segue into the next concept here. First, let's do a question on the board real quick. Which of the following is true of a second mortgage? A, it has priority to the first mortgage. B, it usually has a higher interest rate. C, it cannot be used as a second security instrument. Or D, it is not negotiable. If you guys get this wrong, I'll cry. We just went over this. Don't make me cry. Don't make me cry. If you get it wrong, I will cry. Because that will mean I'm talking to myself. Okay, good. Good, you guys got it right. So I wasn't talking to myself. It usually issued a higher rate of interest. Good job, everybody. Everybody gets a big fist bump, high five. Find that emoji, please. Why do emojis not have noses? Never understood that. They have all these different facial expressions, but no nose. Okay, so it has usually a higher rate of interest. So we said getting a loan is all about risk. Okay, it's all about risk. What is the most important thing that the lender will evaluate to make sure you are not a huge risk, that you're not too much of a risk, that you're a reasonable risk? What's the biggest thing they evaluate? What do you guys think? Most important thing. Okay, so they do look at the FICO score, they do look at your income, but that's not the most important. Brandon Brown nailed it. Nice job, Brandon Brown. The most important thing is the property. The property is the most important thing. Everybody got that? The property is the most important thing. I can't say that enough. You could have great credit and great income and be a wonderful person with a great job and all this kind of stuff. But if your property does not justify the value of the loan, they're not giving it to you. It doesn't matter if you're Mother Teresa and Gandhi all in one. They're not doing it, okay? The property has to justify the value, because if you don't pay them back, that's how they're getting their money back. That's their collateral. Okay, so everybody got that? That's their collateral. If you guys were on the webinar yesterday, we talked about the OREE rule. And this is why I get so frustrated when they say a mortgagor and mortgagee is an exception to that rule. I hate it when people say that because it's a suffix and there's no exception to grammar that we learned in elementary school. Okay? And why do I bring this up now? Because we just said that property is the most important thing when they make a loan. So therefore, they're not giving you any money until you give them rights to that property. And how do you give them those rights? Who knows? Who knows what you are signing and giving to them? Who knows why you are called the mortgagor? All right, when you borrow money, what is it that you're giving them? What do you guys think? Why are you called the mortgagor? What do you think? What do you guys think? Because you're giving that promissory note. Nice job, Orly. Orly. I feel like everybody should have their name chanted at least once every few years. There's got to be something you do that's worthy of people chanting, even if it's just like eating a ton of watermelon at a picnic or something. You guys agree? Everybody's embarrassed when people chant your name, but yet it's also awesome. Okay, so when you give that promissory note, that is the evidence of the debt, which is the collateral, which makes the bank feel better, and then they'll lend you that money. At that point, they'll lend you that money. All right, everybody got that? So that's why it is so important. It's really hard to chant one syllable names. Like my name, Joe. It's really hard to chant. Joe. You need like at least 2 syllables to chant somebody's name. Okay, let's do this question on the board. Thank you, Orly. Okay, the borrower with a construction loan receives the loan amount in A, one sum at the beginning of the construction period. B, stages called draws under the construction period. C, 2 payments at the beginning at the end of the construction period. D, one sum at the end of the construction period. Can't use Joey. That idiot on Friends ruined that for me forever. Okay, I'll read it again. The borrower with a construction loan receives the loaned amount in A, one sum at the beginning of the construction period, B, stages called draws during the construction period, C, two payments at the beginning and at the end of the construction period, or D, one sum at the end of the construction period. And the answer is B, stages called draws during the construction period. Cynthia. The primary purpose of truth in lending is to A, control the true cost to close a transaction. B, disclose the true cost of obtaining credit. C, disclose the true cost of only an FHA loan. Or D, control interest rates on behalf of the consumer. And the answer is B, disclose the true cost of obtaining credit. That's a very fancy way to explain something that's very simple. When you guys deal with certain services, like putting a phone line in or dealing with electric bills or well, getting a loan, doesn't it feel like sometimes they give you a price? Or how about this, when you get your car fixed or things of that nature, and they tell you guys how much it costs, and you thought it's $100. Like, no, it's going to be like $180. You're like, what? You said $100. Yeah, but there's the we screwed you tax, the ha-ha fee, the you're a sucker charge, and like you're the idiot fee and the ha-ha charge and all that kind of stuff. And before you know it, you're paying more and you don't know what any of that stuff means. Kind of like when you go to a hotel and you pay for a hotel that's listed on like booking.com, and then you get there and they charge you this crazy amount for taxes, and they charge you a resort fee, and then they charge you like Wi-Fi access fee and all that kind of stuff. Ugh, angry. Not talking from personal experience or anything. Anyway, so what the truth in lending does is it tries to prevent that, right? It tries to prevent that. It's supposed to give you the cost of getting a loan in an easily comprehensible term so they cannot charge you that we screwed you tax, ha-ha fee, you're a sucker charge, all that kind of stuff. And what they do is they use something called the APR. APR, as I'm sure many of you guys already know, stands for annual percentage rate. And that APR is supposed to be that easily comprehensible number so that you know what it is you're paying for. Has everybody got that? Okay, give me a got it if you got it. Everybody got it if you got it. I'm not saying everybody got it. Right, got it. Am I the only one who's seen that resort fee by hotels in the U.S.? Any of you guys who've traveled outside the U.S., you know you'll never see that. It's an American thing. They charge you a resort fee, even when it's not a resort. It's like a Holiday Inn with basic TV, and they call it a resort because they got some crappy pool outside with some contaminated jacuzzi that doesn't even work. And who else has traveled and they realize that that's only an American thing? It's also only an American thing to charge you for Wi-Fi. What's that all about? Like it costs them extra money for me to like log on to the internet? Once again, if you guys travel outside the country, you do not deal with that. Okay. A mortgage that covers more than one parcel of real property would be which of the following choices? A, blanket mortgage. B, a package mortgage. C, an open mortgage. D, a junior mortgage. I almost feel like if those hotels are going to charge me for flushing the toilet too. All right, here we go. A mortgage that covers more than one parcel of real property would be which of the following choices? A, a blanket mortgage. B, a package mortgage. C, an open mortgage. Or D, a junior mortgage. And the answer is a blanket mortgage. It's basically when you get a loan and you lose more than one property as collateral. Okay, this is not your typical loan. This you don't find as residential. It's more done for commercial. And usually people have special relationships with the bank to be able to do that. Your average person can't do it. Sorry about my tangents today, everybody. Sorry about my tangents. Had a rough experience with people charging me nonsense the other day. Hey, at least you guys know you're getting the real me. Isn't that part of the appeal of our program, real people? Okay, if an individual gives his property as security for a debt but does not give up possession, he has hypothecated the property, B, converted his fee simple title to equitable title, C, conveyed the property, or D, devised the property. What do you guys think? The answer is hypothecated the property. What is the difference between legal title and equitable title? And this comes up a lot with financing. It's important to know. What is the difference between legal title and equitable title? Legal title or equitable title? What is the difference? And it's important for when you get loans so that you guys do understand the difference. So the difference is equitable title represents the right to use and possess and enjoy the equity, hence the name equitable title. Legal title is the right to sell. Everybody got that? Everybody write this. Legal title, the right to sell. Equitable title, use and possess. Write that down. Legal title, right to sell. Equitable title, use and possess. Why is this important? Well, when you borrow money from the bank and you're sitting there watching TV, watching Monday Night Football or whatever it is you enjoy, do you have equitable title or legal title? So when you borrow money from the bank, do you have legal title to that property? Or do you have equitable title? Okay, so what you have equitable title. And the lender, whether it's the bank or anybody else who lends you money, would have legal title. And they have the right to sell the property because you gave them that right. Remember that mortgage or word, the OR you gave when you gave them that promissory note, the evidence of the debt. That was the collateral in case you don't pay them back. Remember that, guys? That was important. Now here's a question, a double or nothing. It's more of a phrase because we really have nothing to double. But double or nothing, here's a question. Everybody ready? It's a tough question. See who's been studying. Okay, I want to see you guys write ready. Right, bring it. Okay, here's the question. When you pay that lender in full, that lender has legal title, what do they issue to you so that you now have legal title? So you pay the lender off completely. What happens after that? So you've given them every penny that you promised to give them, every bit of interest, every bit of principal, the whole thing. What happens next? Oh, Inez Panic nailed it. A lot of you guys wrote D, but that answer is not sufficient. The complete answer is reconveyance deed. Reconveyance deed. Give that lady a cookie. All right, reconveyance deed. Good. They reconvey the property back. Good. Excellent. Remember, deed transfers interest, and there you go. That was a tough one. Right, Roro? I just feel like name Roro would be like somebody I'm best friends with, so I had to say like, right, Roro? I feel like they would give me like a fist bump. Okay, here we go. The application for a mortgage may not be asked about his or her A, national origin, B, number of ages of dependents, C, immigration status, or D, source of income used for repayments. The applicant for a mortgage may not be asked about his or her A, national origin, B, number and age of dependents, C, immigration status, or D, source of income used for repayments. Roro is a nickname for Roseanne. It's true. My mother's best friend, she always called her Ro. But her name was Rosemary, not Roseanne. It was Rosemary was her name. Okay. And the answer is national origin. National origin. Good. I feel like my dog sitting next to me could pass this exam because he listens to me do these webinars every day. I think Gordo would be a great real estate agent. Right, Gordo? Okay, first liens, which take priority over all other liens, are A, tax liens, B, mortgages, C, construction liens, or D, judgments. Okay, first liens which take priority over all other liens are A, tax liens, B, mortgages, C, construction liens, or D, judgments. Nobody takes priority over the government. Tax liens will always take priority. Okay, they always go on first position. That's why very often when you get a loan, they have something called an impound account. An impound account, well, what's that for? You guys tell me. What's the impound account all about? What do you guys think? So when we're talking about financing today, and very often you get a loan, talk about impound account. So the impound account is where they collect reoccurring costs, things like taxes and insurance, that could take priority over the loan. Things that if you don't pay that, then you can't pay the mortgage. So very often in certain circumstances, they'll collect the money for you to make sure it gets paid. And those are things like tax and insurance, because those are things that take priority over the loan. The open-end clause in a mortgage would benefit, I don't want to do this one. Do this one. Let the buyer beware is also known as what? A, lease pendants, B, caveat emptor, C, ad valorem, or D, et tu, etat. Let the buyer beware is also known as what? A, lease pendants, B, caveat emptor, C, ad valorem, D, et tu, etat. And the answer is caveat emptor, buyer beware. So real quick, what are the other ones? So what is lease pendants Latin for? What is lease pendants Latin for? Who knows? Lease pendants is Latin for 3, 2, 1. Lawsuit pending. Caveat emptor, we just said is buyer beware. Ad valorem is Latin for, who knows what ad valorem is Latin for? 3, 2, 1. According to value. According to value. And et tu, etat is Latin for, everybody, here we go. 3, 2, 1. For the life of another. For the life of another. All right, guys. Thanks so much. Thanks for tolerating my little tangents on the day. But we got to keep it real sometimes and be authentic. Got to be me. We do these things all the time. If I read like a robot, I'll go crazy. We don't want that to happen. So with that being said, we will see you guys tomorrow. Tomorrow we got an exciting webinar. And that's that. For me and Adrian and Arthur, good night. How do you sign out that Ron Burgundy movie when he was in Seattle? No, when he was in San Diego. Who knows that? I need to know that before we go. What did Ron Burgundy say when he signed off in San Diego? In Anchorman. What did he always say? He said something San Diego. Nobody knows? Oh well. I have to look it up. Stay classy. Thank you, Pablo. Stay classy, San Diego. All right, tomorrow's at 9 a.m. California time and 12 o'clock East Coast time. Thanks, guys. Night.